Welcome to the Money GPS. You came here for the truth, so let me unveil that for you. Everybody's talking about inflation, but what about deflation? What about recession? All of these things are merging at the exact same time. It's a perfect storm, but I've got the information you need to know. And one of those things is, among all of this, which asset is the winner? I'll give you that first. Let's begin. It was a lousy second quarter, except for the US dollar. So if you were one of those people that simply held on to cash, you lost based on what happened with inflation. But if you compare that to other assets, if you consider it an asset, well, then it certainly fared better. But that's important to note. If you look at what very wealthy people are doing at this time, they are not accumulating. They are taking in the cash that they have and they are waiting to accumulate. And I'm talking about assets. They are not buying the real estate now. They are not buying stocks now. They are taking the cash from their income that they are making from their high income skill, from their passive investments, and they're simply hanging on. Yes, you lose to inflation, but they are waiting and waiting and waiting. So that's really key. Look at here. A 3% mortgage, leverage your stocks to buy a home. A hot new trend among would-be buyers is to borrow against their investment portfolios to access cheap funds as traditional rates soar. Now, I don't think this is a big percentage of individuals, but there's all these different little schemes available. Now, while that might not be a problem if things go relatively well, but if we start to see sell-offs, if we start to see more fear building and recession and higher interest rates and so on, this could create a cascading effect. Look at what's happening with cryptocurrencies right now. Many different companies related to the cryptocurrencies and the cryptos themselves are starting to go belly up, and we're talking about multi-billion dollars worth. All of these things have counterparty risk, many of them, I should say. And these have, of course, domino effect that could affect people that were 10 steps away, but because of this, it's having an impact. So what I say to you here is that people are doing things that they weren't before. And until we see people start to get, let's say, a little bit more cautious, a little bit more stringent with what they do, I don't think we're in that extreme fear category. I really don't, because of the things that I'm seeing. Michael Burry, drugs are hard to kick. Fed was supposed to sell $30 billion of treasuries, $17.5 billion of mortgage-backed securities per month starting June 1st. QT, right? Okay. During June, mortgage-backed holdings rose $3 billion. Treasury holdings fell less than $10 billion. So they didn't get there. Well, one of the things I wanted to note here is that the latest data, while it was posted on June 30th, the holdings were as of June 29th. And you could see the maturity date for some of these, this is T-notes and T-bonds, is the 30th. And T-bills here, you got some coming on the 30th as well. So I'm not trying to give any excuses to the Fed, believe me. You know how I feel about them. But let's see when we get the new data. Okay, the latest data that comes out, I'll give that to you, and then we can have a real update as to what's going on here, okay? Don't forget to hit that like button if you support the channel. Okay, right down there, it's right down below. Just click that button and let's move on to this. My friends in the UK, Johnson weighs 50-year mortgages that children can inherit. UK Prime Minister exploring plans to boost housing demand. I mean, I can't believe it. Boost housing demand. The demand was so hot and you're trying to boost it? You're trying to pour gasoline onto a fire? Really? Okay. But this is not going to be different than other places, okay? I do see this type of thing coming. Unless we get a major deflation that happens. And that's what some people are talking about, okay? 50-year mortgages that you're going to pass on. You're going to pass on debt. Oh yeah, you have an asset, but what happens to a building after, if you bought it new? Okay, a 50-year-old building, it ain't the same as what it was. And if that building was already 50 years old, now you've got a 100-year building. Okay, this is something that is just absurd. It's absurd to pay this much money for something like this and takes 50 years to pay off. There's something inherently wrong with what we're seeing in the financial system, but you've got this obscured from you. The average person does not know, does not have financial education. And that's what I'm trying to do in my own way. And I promise you, the promise to you is that I'm going to take this up more than one notch. Okay? You will see the changes coming soon. L. Arian says receiving liquidity is the biggest risk to market, something I talk about all the time. If you see the last video, the one directly before this one, I talked about the absolute true reason why the stock market fell. You're going to get that right at the beginning of the video. I put it there. Make sure you check it out if you haven't already. This is so important because the liquidity in the system, central bank balance sheets, interest rates, all of these things are the number one factor for what you are seeing. And of course, if that's starting to come off, starting to go away, you're going to have a problem first at the fringe, the riskiest assets, the riskiest gambles and bets and SPACs and all these weird dog-related coins and all these things. That's where it pops up first. And then it starts to hit others down the line. JP Morgan sees stratospheric $380 oil on a worst case Russian cut. So should they simply say, okay, we're going to cut you off, that would create a big problem. I don't see that happening. I think that's as they say here, a worst case scenario. But also at the same time, what they're not talking about is deflation. If you start to hit a recession, it hits a lot of businesses. This is going to bring assets down. One of those being oil. Doesn't mean that oil is not going to be elevated from where it was 2 years ago, but I think it is something that we should be paying attention to with any of these assets. Look at wheat prices have come down. Look at lumber prices have come down. Look at metals. You look at the industrial metals and so on. So a lot, we've come way off the top. There's no question about it, because anything that goes straight up will always come back down. We see where it lands and what it does. But then we have the businesses that are talking about this. One of them, Meta or Facebook, slashing hiring plans, girds for fierce headwinds. This is Zuckerberg, okay? Your friend and mine who's listening to our conversation right now, probably. If I had to bet, I'd say that this might be one of the worst downturns that we've seen in recent history. He also said a funny quote. Actually, I thought this was really funny. Realistically, there are probably a bunch of people at the company who shouldn't be here. Okay? I mean, he's just speaking, okay? So we'll see what happens with Meta. We'll see what happens with all the rest of the tech companies. But people should be paying attention, not to these companies necessarily, but look at all the different companies and what they're doing. They're reacting to the information that they have on hand. If Facebook is going to fire people, they're doing it for a reason, right? They hired the people initially. Now they're firing people, right? So we'll see. Okay. I was talking about oil, and one of the things that I heard basically third hand today, but I also have heard, from different reports, this is an issue, okay, because of all the investment being pushed in to green energy, because of the fact that they're saying, look, if you are going to create one of these fossil fuel type of industries, you're going to create a business around that, you're going to find it to be very expensive, and you're going to have a hard time doing so. And that really became an issue in 2020. They basically said, look, just don't even get into that business. Don't even do it. So no new activity, creating mines and things, drilling for oil. These things are, it's looking like it's becoming a thing of the past. And so as a result, we watch the prices of these things, whether it's oil or what have you, becoming more expensive. But shouldn't it, like, it really shouldn't be the case. Okay, because if there's demand, we should be actively working towards it. If we're not ready to transition to green energy, should we be saying, okay, well, we're going to go to the green energy eventually, but in the meantime, you're going to pay 5 times what you paid for your gasoline and your different energy products. What you were paying a few years ago, you're going to pay 5x for the next 10 years, 5 years, or whatever it might be. Is that reasonable to you? I mean, let me know. Let me know what your thoughts are. I just don't know. You could see the growth or lack thereof. And I mean, this is unbelievable. I showed you the GDP Now statistic, which is basically the Atlanta Fed puts out what they forecast the GDP to be. Okay, gross domestic product. When we look at this, it's essentially the measurement of the economy. How is it doing? Is it growing a lot? Is it shrinking? Is it kind of steady growth? What is it? Well, the latest data that has come from that shows us it would be officially a recession. Now, we've seen these being short before. Look at 2020. It was officially a recession, but didn't last long, right? Grew out of it, the stock market pushed higher, and you saw everything from there. The stock market at this time, right now, S&P 500 real terms, is the worst since 1872. I mean, that's just unbelievable. That's 2022 year to date, but annualized, okay? It's just unbelievable. Now, as I record this video, the markets had done quite well, but we're in this zone of, why has it been coming down all this time? It's because the liquidity is leaving the markets. Liquidity is leaving. A lot of people are parking cash. They're simply waiting. That's why I bring this up, okay? This is just showing us, the first half of the year, total return performance. So while we have seen things come off their top, like oil, certainly they have performed very well. That's all I'm trying to show you here. You can see, like, with the S&P 500 over around that 20% mark, bear markets for a couple of these indexes. War, weather endanger global food supplies, farm leaders say. So there are many reasons why this has been happening, why food prices have been rising. But the reason I mention this, the reason I talk about, declining, as you can see here, this is the Fed Now statistic of minus 2.1%. And this year, Russia's recent steep cuts in natural gas flows to the EU, meaning this is the first month in history in which the EU has imported more gas via LNG from the US than via pipeline from Russia. All of these things together, when you look at each thing I discussed today, for those who stuck around, I think we should be aware of the possibility that before we enter a major inflation, before there potentially even could be a hyperinflation, before we enter that time frame in which confetti runs and is brought down from the skies, we should understand the possibility of deflation. Okay, now over this period, clearly, and basically every level, we have watched inflation. But there has always been this natural draw, this natural pulling of deflation occurring, because you can only hand out so many fake dollars over the course of a year or whatever it was for 2020 and even into 2021. That you can't do that forever. You can't give people $1,400 paychecks. You can't do at the same time infrastructure projects and all of these other things, because it takes its toll. It takes its toll on the currency. And so as soon as you take your pedal off the take your pedal to the metal. What is it? No, take your foot off the. What am I trying to say? Okay, when you take your foot off the gas. There we go. Okay. You basically slow the whole thing down. That's deflation. And as a result, you can hit it back with QE, with stimulus packages, infrastructure packages, and all that. That's inflation. And if you believe that it's simply, not going to have much of an impact, well, you take it to the next step. And you take it to the next step. And then you create a central bank digital currency and you put cash into each of those person's accounts, and then they could spend it and they spend that. And they spend it and they spend it. And more and more and more and more and more. And this creates this massive inflationary issue because people are saying, if I don't spend it today, well, then it's going to be worthless tomorrow. So I'll spend it today. Spend, spend, spend. And of course, the currency gets devalued faster and faster. So that's my message for everybody today. I think that we should be paying close attention to what's happening at the fringe. Understand the fringe, whether we're talking about cryptocurrencies. And you might say, I don't care about cryptocurrencies. You need to see what's happening because that's where a lot of the excess was going. And a lot of the so-called stable coins may prove to be very unstable, and that could have an issue and spill over into the other coins. And then that starts to affect some of these other what would be considered risk assets. So take note of that. Watch out. Don't be afraid to simply pause and understand what's really happening here. If you appreciated this video, hit that thumbs up button. And of course, as always, make sure you join Club 282, okay? Club 282, 282,000 people here on this channel. I want to thank each and every one of you for being here. All of those who had applied to the job, oh my goodness, there's been so many. My inbox is full. I will get back to you, but please give me some time. I got to go through all those and take it to the next level for those who had shown some interest. I'll see you on the next one. Take care.